On January 1st, 2020, Dat Juice Corporation granted 40,000 options to key executives. Each option allows the executive to purchase one share of Dat Juice's common shares at a price of $30 per share. The options were exercisable within a 2-year period beginning on January 1st, 2022, if the grantee was still employed by the company at the time of exercise. On the grant date, Dat Juice shares were trading at $25 per share, and a fair value options pricing model determined total compensation to be $1.680 million. Management has determined there will be no forfeitures because they do not expect any of the key executives to leave. On May 1st, 2022, 12,000 options were exercised when the market price of Dat Juice shares was $34 per share. The remaining options lapsed in 2023 because executives decided not to exercise them. Management was indeed correct in their assumption regarding forfeitures in that all executives remained with the company. Assume that Dat Juice follows IFRS. And were asked to prepare the necessary journal entries related to the stock option plan for the years ended December 31st, 2020 through 2023. All right. Let's see what we've got here. So our first entry is going to be December 31st, 2020. December 31st, 2020. So on January 1st, they granted the options to the executives. Each option allows them to purchase the price. The options were exercisable within a 2-year period beginning January 1st, 2022. Okay, so our first entry is going to be to record is December 31st, 2020. December 31st, 2020. So we're going to have a journal entry there. Okay, December 31st, 2020. We are going to record the compensation expense related to the executive stock options, which is going to be, it says that the fair value option pricing model determined the expense to be $1.68 million. And it's a 2-year period. So we're going to recognize this as the employees serve. So over the 2-year period, that means each year we're going to recognize $840,000. So December 31st, 2020, our journal entry would be debit, compensation expense, and credit, contributed surplus, options. So this is going to be 840,000 and 840,000. And same entry, December 31st, 2021. We're going to have debit compensation expense because it's over 2 years. The numbers are going to be the same. This is simply the second year. Credit, contributed surplus, options, 840,000. Okay, so next we're asked, the next entry that we need to record is on May 1st, 2022, 12,000 options were exercised. Okay, so we've got an entry then on May 1st, 2022, exercise options. So we are going to have 12,000 options were exercised. And the options, so let's take a look up at the question here. So there's some interesting information given. We're told that the market price is $34 per share. But that actually doesn't matter. What matters is the fact that the option is $30 per share. So we're going to record 12,000 options times $30 because that's what the employees paid for the shares. They paid $30. So that's going to give us $360,000. And that's what the company is going to receive from the executives in cash. So they're going to receive debit cash. The executives are going to pay in $360,000 to receive the shares. We're going to need to credit or debit, contributed surplus to clear out the value that we allocated to the options. And how are we going to do that? Well, we're going to say we know that in contributed surplus, we have a total of 1.68 million because we've put in 2 journal entries for 840,000. And 12,000 warrants have been executed, and the total amount of warrants that were issued, if we look up in the question, we granted 40,000 options. So 12,000 divided by 40,000 is going to give us 30%. So 30% times 1,680, which is our total contributed surplus amount, is going to give us $504,000. And this is what we're going to clear out of contributed surplus. This is the proportion of the total contributed surplus that we recognize that relates to the 30% of the options that were just exercised. And the balance of this entry is going to go to common shares. The sum of 360 and 504 is going to give us 864,000 as our common share value. So what else happened? And then it says the remaining options elapsed in 2023 because executives decided not to exercise them. So for December 2023, what journal entry should we record for the lapsed options? Well, December 31st, 2023, lapsed options. Well, for lapsed options, all we're going to do is move the options from contributed surplus options to contributed surplus expired options. So we know, if we look up here, we know we have 1,680 in contributed surplus, and we took out 504,000. So our balance in contributed surplus is going to be 1,176,000. So we're simply going to go debit contributed surplus options 1,176, credit contributed surplus expired options. Just to make sure that we've got that classification clear so that we know we're not going to have to reverse out the expired option piece. So this is simply a classification within the contributed surplus account. Because we have these little notations beside it, we're simply making sure we've got it with the correct notation. All right, so I think we've finished all the journal entries here. Now we've got a couple questions. What is the significance of the $25 market price of DAT juice shares at the date of grant? Would the exercise price normally be higher or lower than the market price of the shares on the date of grant? Well, the market price of the shares on the date of grant would normally be lower than the exercise price for the options, because the point of the options is to incentivize the executives to work towards increasing the company's value, therefore also creating value for themselves through their options. There's no particular significance of the $25 market price on the date of grant, although we presume it would be lower than the exercise price. Well, it is lower than the exercise price of $30 per share. What is the significance of the $34 market price of DAT juice shares as at May 1st, 2022 on the date of the exercise of the stock options? The $34 on the date of the exercise of the options is not used in recording the exercise of the stock options. The market price of the options is not relevant from an accounting perspective. that what matters is the value of the option itself, which was the $30, and that's what the executives paid into the company when they exercised their option. What's relevant with the $34 is simply the decision for the executives as to whether or not they would want to exercise their option. So presumably, the $34 is higher than the $30 of the exercise of the option, meaning that the executives would make $4 a share if they exercise their option as of May 1st, 2022. So that's simply for their decision-making rationale. It doesn't have any impact on the accounting. We ignore the $34 from an accounting perspective. We're only concerned with the $30 strike price of the option. What likely happened to the market price of the shares in 2023? Well, in 2023, we can see that all the remaining options lapsed. So presumably the share price was less than $30, meaning that no one's going to pay $30 for a share that's only worth, say, $20 or $25 because you would lose money. So presumably the reason that all the options lapsed is because the share price dipped below $30. And that concludes this question.